Okay, first thing to remember, the income statement is not just any report, it's everybody's favorite report. If the income statement is not one of your favorite QuickBooks reports, there's something wrong with you. You have a problem, okay? I don't mean to be rude or anything. I know everybody's a little sensitive these days, but no, you have a problem. You need to fix it because this is one of the major financial statement reports. It's everybody's favorite reports. The balance sheet, the income statement, are the financial statements. All other reports are typically giving more information about one or multiple line items on one of these two major reports. Now, there is one other report that we typically think of. That's going to be the statement of cash flows, which we will talk about later. But even it can kind of be thought of as something that is constructed from the major two financial statement reports. In other words, if you built the reports in order, you would make the balance sheet, income statement, and then generally construct the statement of cash flows based on that. You might also have a statement of equity, but that's kind of in the balance sheet. Now, also, just quick note, if I go back to the tab on the left-hand side, you'll recall that we have all these other kind of income statements: a profit and loss by customer, profit and loss by month, profit and loss by tag, profit and loss comparison. Most of these reports can be generated, constructed from a normal profit and loss. They're not really new reports. They're just alterations of the report that we are on, and we'll see how to do this shortly in future presentations in a similar way as we already saw how to do some of that functionality in a prior section or course on the balance sheet. So let's go back on over to the profit and loss. Now, the first thing we want to note is the profit and loss, and I'm going to do a little bit of just accounting work here because we want to really understand these reports. So the profit and loss, for terminology's sake, is also the income statement. So if you learned from a book problem perspective, you learned in a college textbook or something, you probably didn't call it a profit and loss, you called it an income statement. That in and of itself is important to know, because if you're talking to bookkeepers in accounting world, people that learned from software, they're going to call it a profit and loss report. If you then talk to the CPA firm or auditor, which you're going to need to do if you are on the bookkeeper side of things, meaning you're kind of in the middle, you're talking to the accounting department and to management, and then you also have to talk to the CPA firm or at least the tax preparer. A CPA firm or tax preparer is usually going to be using the lingo of an income statement. So that's noting. We can also change the name of that by customizing it if we want. If we're dealing with a client that prefers the name income statement, we could, of course, change the name to an income statement. Other thing to note, what are we using these financial statements for? At the end of the year for the United States, we have to at least do tax preparation, no matter what type of entity we are. If we're sole proprietorship, partnership, corporation, some type of income statement typically will be required. The profit and loss report is the main report that we need for the income statement because it is the performance report, which we'll talk more about later. Now, note, you might say, well, man, why don't I just do the income statement outside of accounting software if I only need like one report? I don't even need the balance sheet. I'm doing all this work on the balance sheet over here, and I don't even need it if I just need it for tax preparation. Well, you do need the balance sheet if you're doing the double entry accounting system, which helps you to not have errors because that's part of the double entry accounting system, the balance sheet. So if you're sole proprietorship, back to the income statement, you're not going to be doing data input into tax software for the entire balance sheet possibly, but you still want to do the bookkeeping with the double entry accounting system, which would include the balance sheet. All right, next thing to note, the profit and loss report has a time frame. It's got a beginning date and an ending date, which might include a month, it might be a year, it might be a quarter, but we have to have the starting point. The report will differ if you change the beginning date. Different than the balance sheet, which is as of a point in time. The report will not differ if you change the date range. So let's just recap that. If I go over to the balance sheet over here, note that I have the year ended. If I just look at this 2025 and I look at that 2001, notice if I change this date to 12/31/25, same day, then there's no change to that ending number right there. So why would I have a range up top? Well, the range is important if I drill down on the report, because then I get to what we might call a GL type report, the transaction detail report, which is a date range. And therefore, the range is still kind of important on a balance sheet, but doesn't actually have an impact oftentimes on the balance sheet report itself. Whereas on the income statement, it will have an impact. We see the 4,700. If I change this just to the month of December by going 120125, then of course we get much different. We have nothing. Nothing is there. Much different numbers. If I change this to 110125, then we're going to, still nothing is there. I want to go to, I think the data was in 2024. Let's go from 010124 to 123124. And so that's where our data is at. So let's pick that up. So in any case, we have to change, the beginning date becomes important. So we want to kind of think of the income statement. I would compare it to, say, for example, testing how far you can drive in a day. How would you do that? You're going to start with the odometer that measures miles, and at 0, you're going to drive for as far as you can, like 100 miles in a day, and then you get tired and you sleep and you start the next day. The next day, you could start the odometer at 100 miles and then drive another 100 miles and then subtract the 200 miles from the 100 miles to see how far you went in day 2 compared to day 1. Or you can reset the odometer in day 2 to 0 again and count upwards. That second is what we basically do in the profit and loss. All of the accounts are going up in one direction. They're going, the revenue accounts going up when we generate revenue, expense accounts going up from the perspective of expenses are going up in order to generate that revenue. And then periodically we refresh the odometer, resetting it, closing it out to the balance sheet. That's how the income statement is related to the balance sheet, so that we can then count the next period from 0, the next month, the next quarter, the next year, whatever that period may be. That's the general idea. All right. So then let's take, now the next thing to note here is if I look at the major accounts on the income statement, we have income, expense. That's mainly the two types of accounts, income and expense accounts. You might note that the double entry accounting system, when expressed not with debits and credits, but with an accounting equation, is assets equal liabilities plus equity. And there are no assets, liabilities, or equity on this income statement. So how in the world is it part of the double entry accounting system? Do we have to do the balance sheet and then just tack on the income statement that doesn't really fit into the double entry accounting system? Well, no, it's part of the double entry accounting system. How? Because if I go to the balance sheet, you'll remember that this is the assets equal liabilities plus equity. Assets, what the company has, liabilities and equity, who has claim to those assets, either a third party like the bank or the owners, whether the owners be a sole proprietorship, partnership, or a corporation, equity representing the ownership. If I rewrite this from the perspective of the owners, I can say assets minus liabilities equals equity, equity then being the book value of the business from the perspective of the owner's share in it. So that equity then is kind of like the bottom line. So if I just look at the equity, that's kind of like the bottom line value, well, hold on a sec, of the business, right? This 20, in this case, it's negative, negative 7,695, right? And so then I can ask, well, that's where we stand. How did we get there? How did we get there? That's where the income statement comes into play. So the income statement is the timing statement that's telling us how we got there. And we can see here that net income is now being included in the equity section. That's us rolling net income basically into the equity section. So over here, you got net income at 131 for January through December. And over here, let's make this as of the end of 2024. So we have the same range so we can see what's happening. So I'll then collapse this again, and then I'll go down here and collapse this here, boom. All right, so now we've got 131.54, and the 131.54 has now been included in here. So basically, everything that happens on the income statement, you can summarize as part of equity, meaning income is going to increase equity because it increases net income, and the expenses are going to decrease net equity because they decrease net income. But we're going to give that detail in the form of an income statement, because that's going to give us the performance statement the major activities that are changing where we will stand at the end of the period. So at the beginning period, the balance sheet shows where we stand. Then we have increases and decreases for sales and expenses, which are going to increase and decrease equity. But I want to report all of those increases and decreases on the profit and loss report to measure the steps forward, the miles driven that we did over a period, month, quarter, year. That's the general idea. All right. So that means that the income statement really only has two kinds of accounts, income and expenses, meaning income is us generating revenue. Expenses are the things that we had to consume in order to generate the revenue, noting that the income statement represents the objective of the business, which is revenue generation. Now, again, you might say, well, no, my objective is to save the planet. I'm like X, or what is it? SpaceX has an objective of saving the human race, the whole human civilization, by putting us on Mars, so that like if the world gets hit by an asteroid, we can still survive because and it's like, okay, yeah, but you have to there's got to be a viable way to do that. You have to be profitable to do that. You need the profit motive in order to put people on Mars, because the government's too inefficient to do it without a marketplace. They're too stupid. You need the market. You need capitalism, man. And that's why Musk makes money while he puts people on Mars, because he's smart. He's smart. Okay. So that's what we need to do. So revenue generation is our objective, and the expenses are the things that we had to consume in order to generate the revenue so that our organization is viable, so we're not wasting a bunch of stuff like government organizations do, so we can actually put someone on Mars or whatever we're trying to do, because we're being efficient about it. We're making it like actually work.